FNB Namibia, and they released their interim results today for the period ended December the 31st, with a 12% increase there in headline earnings per share. Now, the group declared an interim dividend of 46 cents. That's against 41 cents declared the previous year. Let's break down the numbers, crossing over to Leyenaar, the CEO at FNB Namibia, joining us from our NBC studios in Windhoek. Thank you so much for joining us today, Ian. Good to have you on the show again. Let's just talk about the income side of your business, because just looking at the net interest income sitting at a 10% increase there to 448 million Namibian dollars. Talk to us about the net interest margins that you have at this point in time, given the fact that you have pointed out that it's been quite difficult to increase that, given the fact that interest rates are at the low point in the cycle.
Yes, indeed. What was very positive for us was our advances growth year on year of 18%. And we've also managed our margins quite well in the low interest rate cycle. But I think more on the non-interest revenue side, where we were up 19%. And if you extract previous years' specific items, then you'll find our results are quite pleasing, and which is driven largely out of our strong retail footprint through growth in new business, new accounts, and of course volumes. Mm-hmm. And then about 18 months ago, we introduced our investment banking arm through FNB Namibia, and they are starting to come through nicely for us.
Let's talk about the ratio of non-performing loans to average gross advances sitting at 0.9%. I mean, just looking at banks in South Africa, I mean, that a very commendable level to be at right now. And it's also come back from the previous year, 2011, where it was 1.3%. So it seems that bad debts are under control at the bank right now.
Very much so. We believe our book is very clean, and you're quite correct. We worked quite hard on that, and there's a lot of focus on the non-performing loans book. So it's been a clean-up exercise, and so we're well positioned, and hence, as you can see, the escalation in the asset growth going forward. Obviously, at these low levels, we expect as the economy picks up and we grow the book, it is likely to increase and normalize at a slightly higher level than obviously where we are at the moment.
Mm-hmm. So an increase, as you say, as you increase advances further. Let's talk about non-interest income relative to interest income right now, because slightly in favor of interest income, which is $488 million, which I referred to earlier, and then you've got net interest income, which was up by 20%, so more than double the rate of the interest income portion. Is that something you specifically focused on? And what is the ideal split that you're looking at between the two?
Well, it's important, particularly in a low interest rate environment, that we have focused on the non-interest revenue streams. And as I mentioned earlier, it's largely driven through the growth in new business, new accounts, and volume growth, which has seen this nice uptick, and we expect that to continue in the future. And then obviously, there's new products that we've introduced towards the end of last year. We introduced e-wallet, which is the only type of product that is currently available here in the market. So we expect a lot of growth going forward there. And there's a lot of focus in many other areas. We've set ourselves a task to go to more self-banking channels in the electronic stream, and we are very strong in that particular area on our online banking and our electronic delivery, and that will further increase during the coming year. So we're very positive as well for the outlook, and we're very pleased with the results. In terms of the split, we don't have a definitive split. In a low interest rate environment, obviously our interest earn does come under pressure a little, but I guess a 50-50 split would be where we would like to be.